Well, we're going to get some perspective now and reaction from Bill Gross. He's the co-chief investment officer and chief over at PIMCO, where he runs the world's biggest mutual fund. Bill, you don't really need that much of an introduction there because our audience knows you so well. I want to get your perspective. What jumped out at you from that interview with Mr. Lacker? Any surprises in there?
Well, no surprises. I think Mr. Lacker is rather on the perimeter, I guess, of the main core of Fed governors. So some of his positions have been well publicized, but nonetheless are controversial. I think one of them has to do with the exit strategy that he discussed in the past 10 or 20 minutes, and suggesting that probably the first thing he would do would be to sell some of the assets on the Fed balance sheet, primarily mortgages, although he wasn't specific in terms of timing. But to my way of thinking, that's very controversial and certainly not the opinion of the core of Fed decision makers.
Asset sales shouldn't be at the front of the quantitative easing reversal here. I mean, but you're concerned about the level of indebtedness and the Fed's balance sheet right now, but you don't think that's the right first step?
Well, I think I'm more concerned about the level of indebtedness in terms of the Treasury's balance sheet and the overall U.S. government deficit as opposed to the Fed's balance sheet. Yes, in a chart that you showed 10 minutes ago shows the Fed balance sheet at over $2 trillion, and that's a lot different than what it was. But it's been necessary over the past 12 months in order to stabilize financial markets, in order to lower mortgage rates, and to the extent that Mr. Lacker thinks that the first strategy should be to sell mortgages, I would suggest that there's going to be enough pressure on rates simply by stopping the purchasing of mortgages at the end of this month. The selling of them would put substantial pressure.
Yeah, that jumped out at me too. He stood by and said, you know, March is most likely, you know, when the Fed is going to stop purchasing those mortgage-backed securities. And there are plenty out there who say that you look at a steepening yield curve, and that means that mortgage rates are also going to continue to go up at just the wrong time for consumers when the Fed stops purchasing. I mean, what level of concern should we be having about the possibility of this?
Well, I think we should be concerned. The problem is we don't have models, and the additional factor to consider is simply that other central banks, the Bank of England, the ECB, and even the Japanese central bank are all pulling back in terms of their quantitative easing measures at almost the same time. I mean, together they've provided $2 to $2.5 trillion worth of purchasing power to replace what's disappeared in terms of the shadow banking system, and so we should all be concerned. This is really the first step in terms of tightening, not in monetary tightening, but tightening in terms of credit, and so we need to wait for 3 to 6 months to see what the effect is, not only on interest rates, but on economic growth going forward.
So another 3 to 6 months past March to see just how the market can digest that move.
Yes.
Interesting. I want to also move from Mr. Lacker's conversation. I do want to get your read. He said inflation, in his view, is low and it's steady. What did you think?
I think so. The Dallas median, and there are a number of inflation indices, came out today. The core PCE is moving down. It was flat on a month-to-month basis, and we are likely to see, according to PIMCO estimates, you know, a core inflation rate approaching zero, not at zero, but approaching zero over the next 12 months. So inflation is really not a problem. There's a lot of capacity, excess capacity, certainly in terms of unemployment and in terms of industrial production as well. That typically, and in our opinion, will continue to produce lower and lower rates of inflation as opposed to higher rates of inflation. So the argument is really in terms of the production of quantities of money as opposed to the slack in the economy in terms of employment and industrial production. We lean towards the latter as opposed to the former in terms of an important influence.
You know, something that we didn't discuss with Mr. Lacker, but is still very much of interest to the marketplace around the world, is what's happening in Europe with the fiscal situation in Greece in particular. I know in looking at the PIMCO Ring of Fire, you've got Canada and you've got Germany in sort of safe territory within that. But given that the expectation is that Germany would be helping to bail out Greece in some form, that there would be European intervention with probably Germany at the forefront of that, does that make you more apprehensive about the bet on Germany here?
Well, I think it does. We would prefer to see a lower bailout as opposed to a higher bailout. The number mentioned this morning, at least, has been in the 5 billion euro category for Germany alone, a larger package in terms of the total. But to the extent that individual countries' balance sheets are contaminated by guarantees and extensions of credit, yes, that leads to questions in terms of sovereign viability down the road. The United States has a substantial portion of its own balance sheet contaminated by agencies, Fannie and Freddie and the like, going forward. So Germany's not alone. Canada's probably in the best shape in terms of all of those guarantees and contingencies. And so, PIMCO and the rest of the world can't all buy Canadian government bonds, but it's a start.
But is that changing your overall call on Germany right now? It's just something you're watching?
I don't think so, because Euroland in Germany itself are moving close to the zero line in terms of economic growth and certainly lower in terms of inflation, and that puts the ECB on hold. What we would do in Germany is basically buy the front end of those yield curves that are predicated upon the potential for the ECB to raise rates. We think that that's certainly not the case. They won't lower rates, but simply keeping the rate at 1%, should lend support to the front end of those yield curves. And as I mentioned, they're a better sovereign risk, certainly in terms of Germany and France, than some of their competitors, such as the UK.
Lastly, Mr. Gross, I was reading your investment outlook today, and you were saying that kings and serfs are beginning to share the same castle, as you put it, in terms of what sovereign debt yields look like and corporate bonds. Explain that to me.
Well, sovereign bonds, to some extent, are moving into credit space. That's what that means. It means that, for the perfect example, it means that Greece, 6 months ago, where an investor in sovereign space would have been dependent upon interest rate changes and monetary policy, is now dependent more on the creditworthiness of the country. And so there's a morphing, there's a transition between interest rate space, which sovereign credit's presumed to be in, into more credit space where the viability of the country is at stake. And so we see interest rates moving from 70 basis points to 400 basis points over in Greece, simply based on the credit.
And we have to leave it there, sir, but very quickly before we go, are you still standing by your call that interest rates in this country are going to stay at 0 through 2010?
Well, I think certainly in 2010, I mean, the interest rates in this country are dependent upon inflation, inflationary expectations, and as Mr. Lacker might have mentioned, the rate of economic growth and the slack of it. None of those conditions have changed, for the negative, and so the Fed should be on hold for at least 2010.
At least 2010. Thank you so much. Bill Gross joining us this morning.